U.S. stock futures pushing higher today on reports that the Trump administration's coming wave of tariffs will be more targeted than the barrage that the president has occasionally threatened. According to reporting from Bloomberg and the Wall Street Journal, it's a sign of relief for markets gripped by this anxiety, crippled in some cases, and you can merge the two words together if you'd like to, like I did. But ultimately, that anxiety has knocked around Wall Street because of the threat of an all-out tariff war. Joining us now to discuss how this will all play out, we've got Peter Harrell, who is a non-resident fellow at the Carnegie Endowment for the International Peace. He previously served as Senior Director for International Economics and Competitiveness in the National Security Council during the Biden administration. Great to have you here with us this morning. So, this is what we had been discussing, and the mindset around the Trump administration potentially being more targeted than just wide-ranging and sweeping tariffs. How should we be thinking about this now going forward, and for what CEOs have been trying to do and making sure that they're clear of some of the tariffs that are coming forward?
Well, thanks for having me on this morning. I keep two things in mind when I think about the Trump administration and tariffs. First being, as we've seen over the last 2 months, nothing's final till the president says it's final. So we're clearly seeing a shift in tone out of administration officials speaking to the press, out of administration officials you talk to privately. But I do think we have to keep in mind nothing's going to be final until April 2nd, when the president actually rolls it out. With that big caveat, we do see some evidence that at least the cabinet, at least the senior members of the administration around the president, are now planning for a somewhat narrower set of tariffs on April 2nd than we had been hearing about a couple of weeks ago. Though it's important to understand that this is still a quite broad set of tariffs, just not as kind of spectacularly broad as it could have been a couple of weeks ago. I think we see two big changes, again, in terms of the messaging coming out of the administration. So the first thing is they're talking about imposing these quote unquote reciprocal tariffs only on a subset of America's trading partners. Now, these are going to be America's biggest trading partners. They're talking about doing it on, countries like Vietnam, on some of the European countries that are our biggest trading partners. So while it will be a subset of our trading partners, it will be a large share of trade. The other thing, two important things they're talking about, is it looks like the potential rate might be a little bit lower than the sort of 25-30% some of us had been thinking a couple of weeks ago. So we might be seeing a somewhat lower rate. And then they're making clear that they will not, at least for now, probably be stacking sectoral tariffs on top of these reciprocal tariffs. And just to briefly give a sense of what that means, if you have stacked tariffs and you have a 25% metal tariff and a 20% reciprocal tariff, that's actually a 45% tariff. And they're now talking about putting that on hold, but still expecting some big announcements on April 2.
Who is behind these headlines that we're getting on tariff changes from the White House, Peter? And I ask because I think it's important for investors to know whether President Trump actually does care what the market's doing and therefore is walking back his tariff policies behind closed doors, or if this is just the economic side of the White House trying to appease the market and this is kind of much ado about nothing.
I think this is the big question. I mean, just in the last couple of days, we've definitely seen National Economic Council Director Hassett. We've seen Treasury Secretary Bessent all talk about the narrower scope. We've also seen some information that I think has been attributed to Secretary Lutnick over at Commerce, who, of course, has been a major hawk within the administration. So we're definitely seeing this out of multiple points in the cabinet. That said, I think you are making exactly the right point. We don't know that this is going to be narrower until we actually see what the president says. And I use the Canada and Mexico tariffs as an example, where some of the economic side of the House had not wanted 25% tariffs on Canada and Mexico. Trump brought them into force. There was a bad market reaction. They then pulled back. So I think the market is resonating, but whether it has really gotten through to the president himself, I think remains a bit TBD.
How much do you think globalization is baked into so many companies' valuations and growth, as it specifically relates as well to the U.S. growth in itself, as we think about how these companies contribute to GDP? That's a larger consideration if we're now cutting off some of those larger globalization efforts of the past.
Yeah, so clearly, the president campaigned on an anti-globalization agenda and on, as he puts it, an America First agenda. So it's not surprising to see this playing out. That said, I do think, as you say, when we look at these sweeping tariffs, there are ways in which these sweeping tariffs actually undermine efforts to rebuild American manufacturing. If you have 15, 20% tariffs on auto parts that then are going into autos that are being assembled in the United States, that's actually increasing the cost of building autos here in the US. Another example that I think the administration is going to have to grapple with, the tools to make computer chips, semiconductor manufacturing tools, a lot of them are made in Europe and in Japan. And they cost like $100 million a piece. And so if you put a 25% tariff on that, you're actually going to increase the cost of making computer chips here in the United States. So I think they really need to grapple with, is this really broad approach to tariffs the right way to accomplish their objective of rebuilding manufacturing? Or should we have something a bit more targeted? One final point, because you talked about earnings. Look, I think big U.S. corporates have a low tariff environment heavily baked into their earnings, sort of earnings estimates. One estimate I saw a couple of weeks ago, before we've gotten these narrower reports, but the initial kind of reports of 25% reciprocal tariffs on pretty much everyone could have been a 16% hit to S&P 500 earnings this year, because that would be the cost of actually paying the tariff. So I think there are some real potential earnings implications here for companies that are dependent on imports.
Peter, great to see you this morning. Thanks so much for taking the time with us.
Thank you.